service contract because we did not have the right to use or to control the leasing equipment and or any type of assets. So we will consider it as a service lease, which containing sometimes a leasing contract, but from the leaser side only. The definition for the new leasing contract increased the focus on the control. The leaser or the leasee has the fully control to change or to reuse or to decide the shape of how can they get use of or the right use of this leasing contract. Maybe change based on the leases. However, in some other industry, they did not have the right to use the leasing contract. So in this case, we will consider it as a services contracts, and this service contracts may contain some leasing services to provide a better services. And there is no any payment, leasing cash flow payment out, unless at the end of this services contract finish, where they will pay for all of those fees. Two major options exempted make the standard easier to apply with the short term, less than 12 months, and using of the amount of more than $5,000, for example. The leasing liabilities, once we have any delay for the leasing payment, there is a terms and condition to have a new present value for the outstanding payment for the lease rentals, plus the value added of expected payment at the end of the leasing contract. The payment is on the index or rate. The payment for the old one based on the turnover of usage. So the score or leaser accounting scores here, which is the leaser accounting, remains similar to the current practices. There is no leasing classification, finance leases and operating lease, but lacks consistency with the new leasing accounting model. In IFRS number 16, there is essential kill sales and lease back as a off balance sheet. If there is a sales on balance sheet at the cost, but in the fair value will be on balance sheet in financing potentially at the fair value of this leasing assets. That's happened in 2019 and has been prepared in 2018. This is before COVID-19. But during and after, what is the situation and how we can benefit from these changes? This is our topic for today, as the COVID-19 impacts on the changes of or the revised IFRS number 16. The entities across the industries are facing a lot of significant challenges, especially in the cash flow payment in the short term. One of those cash flow out, which consider the cash payment settlements for the lease cash payment. And our IFRS number 16, leases became efficient for annual period beginning on the 1st of January 2019. The world went through various challenges, and that will make a lot of another challenges on the lease transaction and its disclosure. So the changes in leases congestions, which is one of the key matter to be focused in a list of various challenges, which is the terms in the lease arrangement, maybe delaying in some arrangements or postponing some leasing points. So how can we use these changes in IFRS number 16 or revised IFRS 16 in these challenges? Voluntary support by the government for leaser and leasees. material arrangement between the lease and the leasers. Operating lease. On the effect of post-COVID-19 or during the COVID-19 pandemic, the risk for delaying or non-paid amount or unpaid amount for the leasing contract risk has been raised up, and there is a loss of payment has been delayed and required to be delayed or postponed. In this case, we need to ask a question about what is the main approach permitted for the recognition of returns of outstanding leasing or operating leases income, when the power of collectability of leasing payment is in unsecure position. How can we deal with this approach or this issues? In this case of uncertainty of payment and reducing the future collectability or uncollectability for leasing payment, we have main two approach. In IFRS number 16, paragraph 81, they didn't contain specific requirement that apply when this is collection uncertainty. Subsequently, multiple approach has been applied in this case, because in the post-COVID-19 there is a lot of challenges, and so many uncertainty behavior could be expected in this case, and there is no clear rules and regulation has been highlighted by the IFRS number 16. And also in paragraph 81, the IFRS number 16 does not contain specific requirements that applied when there is collection uncertainty. And there is two main approach in this case has been resulted in lacking of requirements in post-COVID-19 and changes of IFRS number 16. Approach number one. In this approach, we have to follow in occurrence of accordance with the predecessor standard to the IFRS number 16 and IAS number 17, was to continue to recognize operating lease income and test operating lease collectability of receivables for impairment. This is has been recognized. The operation income would cease when the lease contract is no longer in force. For example, the leaser exercise its contractual right to evict the tenant on account of payment delinquency. So in approach number two, the support for this approach comes from the lacking of specific requirements in IFRS number 16. So it will be a negotiable issues, and it will result in any assets that was recognizing meeting the definition of assets in the conceptual framework of this international financial reporting standard number 16. Whereas continuing to recognizing income in a straight line based could have the uncertainty over receivable uncollectability, result in a receivable being recognized that does not meet the standard definition of an asset, and that will create another definition of a leasing contract, not considered as a leasing contract, because the amount of money has been changed, and also the period of time has been delayed for more than 12 months, so it be considered as a service assets. So the continuing recognizing income on the straight line could very significant uncertainty over the collectability, and that will result in considering the collectability receivable straight line payment will not meet the definition of an asset or the definition of this type of leasing contract. So, for example, on January 2019, lessor and lessee and lessor entered to a contract of leasing of retail space for a specific leasing period of time of 5 years. And was the leasing payment was the 100 per month, 100,000 dirham per month in advance for each month. In March 2020 and in post-COVID-19, there is some challenges has been added the load for the lessee in order to pay or follow the payment as a straight line payment for leasing. And from the 1st of April 2020, the lessor expect there is a significant uncertainty that will be able to collect the 100,000 dirham per month in advance. So the lessee indicate that they will only be able to pay 40 instead of paying 100. The lessor believes that 40 will be collectible due to the significant financial difficulties the lease is experiencing due to the effect or the impacts of post-COVID-19. And we have two main journal entities for this case. Approach number two, let's start with approach number two. The occur or the occur to the extent collectability of receivable money will debit the operating lease of a receivable amount of money of 40 instead of 100, and this is what we expected that we will collect from the lease or lessee. The operating lease income will be 40 instead of 100, so credited and the receivable is 40 and the lease income will be 40. In this case, we expected that these cases would continue more than 1 month or 2 or 3 months during the pandemic of COVID-19 in this case, so they will consider only 40, and after that the 60 will be collected as a one premium in the future time, but we have to decide what type of discount rate we will consider the 60,000 for 3 or 4 months of the effect of post-COVID-19 in the future time. This is for approach number two. Approach number one, to record a gross lease income, so we have to debit operating lease for the actual pays 100 in the contract, as the contract says, and to record only expected credit in the future of 60. That means we have already collected only 40 from the 100,000 operating lease receivable in the future time. So we will decide not what we have already collected, but we will decide what is not a collectible amount for the future time. So as a result, can lessor change the basis over which they recognizing operating profit and income, leasing income? In post-COVID-19 circumstances, and the IFRS 16, the lessor shall recognize leases payment from operating lease income or either a straight line of payment. The lessor will have to develop accounting policies for leases prior to the impact of post-COVID-19 in most operating lease income. So we have to recognize on the straight line base, as this generally represents the pattern in which the benefit from the use of underlying assets is diminished. So over time, the underlying assets will diminish over time because of the consumption in the lessee's hands. Can lessor suspend or modify the basis for predictability or depredicting an underlying assets building when the tenants are not permitted to assess due to the government lockdown. So generally speaking, we can say that IAS number 16, paragraph 50, requires that the predictable amount of the asset to be allocated or collected or allocated on a systematic base over the useful life. In IAS number 16, paragraph 55 require that emphasis decided the depreciation of assets cases at the area of data that the asset is classified as a hold for sale. And also in accordance with the IFRS number 5, the data that the asset is recognized or derecognized. The situation that may not result in leasing motivation and to account the impact of the profit of post-COVID-19 or losses. So modification are specify the coverage original lease arrangement, and also thought not specially covered but are used due to the government action and imposition resulting into rent concession which fall under the phase measure of the agreement. When rent concession result in lease modification, in this case, either the coverage in the lease agreement nor the government action and not proportional or proportional delivered. So then entity needs to readjust the right of use (ROU) and the liabilities by the recognizing the revised discount rate. So we have to change the risk for expectation for uncollectability or the power of collectible receivable leasing lent by hiring the risk and the discount rate in terms of revising the discount rate and revising payment and the lease period and make necessary accounting in the book of the accounts. Some other issues regarding to the noted that entities may include a rent holiday or rent reduction alone is not the change. When the terms of agreement to be reviewed need to consider all other relevant facts and subsequent issues, reassessment of lease period of time and impairment of the ROU as due to the challenging of the business phases in post-COVID pandemic, and for lease receivable are subject to IFRS number 9 impairment requirements. So the lease modification and accounting treatments, we have to have a leasing modification challenged for the scope, challenges or consideration for the lease, and if it's a condition to the challenge for the scope, what we have to do and what are the discharges which is result of the original contracts or applicable law of the rules and regulation issues. And if is it no, so the result in modification to be accounted as per the International Financial Reporting Standard, paragraph 44, 46, and in of 16, IFRS number 16. Situation that may not result in lease modification and to account the impact on the report of profit and loss statement. So the modification are specifically covered in the original lease agreement through not specifically covered by the government action and impairment issues. Rent deferral, which is the proportions or proportional or proportionate without a range of overall conditioning. So we have to search for what's so-called p-value or not p-value, net present value issues. In case of the present value is higher than the cost and the period of time that we have already spent. So we could accept this agreement. So the IFRS number 9 add that we have to collect appropriate discount rate or revised discount rate to gain more appropriate present value for outstanding order for the payment in the future time. When rent concessions result in lease modifications, we explained this issue when the entity need to readjust the right of use and also the revised lease present value payment. This is for the IFRS number 16, and in number 17, which is talking about the insurance contracts and reinsuring issues and reinsurance contracts. In this standard, number 16 established the principle for recognition, measurement, and presentation disclosure for all about the insurance contracts, which is in the scope of the standard, and this has been made in January 2020, and the change will continue up to the 1st of January 2023. And it's all about the insurance contracts and the presentation, measurement, and recognition of the returns of this insurance industry. Finalize. IAS B finalized the narrow scope of amendments of IFRS number 17 and IFRS number 4. The amendments are effective for annual period beginning on or after the 1st of January 2023, and the IAS B has also published extension of the temporary expectation or exemption from the applying the IFRS number 9, which is the amendment of IFRS number 4. To differ the fixed expiry date of the amendment, also annual period beginning or after the 1st of January 2023. The scope of IFRS number 17 is apply all type of insurance contract, life, non-life insurance, health insurance, direct insurance, indirect insurance, and also the reinsuring contracts. Regardless the type of this type of insurance, the financial instrument with the creation or discretion of the participation feature, a few scope has been applied in IFRS number 17, especially in the reinsurance contract. So the key requirements here is to provide accounting model for the insurance contracts. It provides a comprehensive model for insurance contracts covering all type of relevant contracts in the insuring industry, and the scope is applying general model and supplement by the specific adaptation for contracts with direct participation feature, all variable fees approach, or specified approach, more narrow, and decided the premium allocation approach, mainly for short duration contracts, only for the short duration contracts for less than 1 year, and generally speaking regarding to the comprehensive model for insurance contracts. What are the main changes that have been occurred? Differ for differential of the data of initial application of IFRS number 17 by 2 years or annual period of time beginning on the 1st of January 23. Additional scope exclusion are directed to the credit card contracts and similar contracts that provide insurance coverage, as well as optional scope exclusion for loan contracts. So short-term contracts and short-term insurance contracts for credit cards and draft overdue loans. Recognition of insurance acquisition cash flow related to the expected contracts and renewals, including transition, prevention, and guidance for insurance acquisition. Some specified insurance contract highlighted the statement of financial positions, So that entity will present the insurance contract assets and liabilities in the statement of financial position. The transitions and additional transition relieves for business combination and the additional insurance relief for the data of application of the risk mitigation option and the use of transition approach. Some small amendation has been made and minor using the minor application contemporary issues. The main feature here is mainly about the model for insurance contracts are as follows, which is the amendments of the present value and the future cash value and incorporating explicit risk adjustment. Some contractual service margin, or SCM, that is equal or opposite to any date or any day one gain on fulfillment cash flow of the group. Some issues regarding to the changes in expected present value of future cash are adjusted against the CSM. So we have to adjust the present value of the future payment regarding to the future risk of insurance contracts. That will readjust again against the CSM or the contractual services margin. And therefore, there is a reconsidered in profit and loss over the remaining contractual services period of time. The interest rate and benchmarking approach, the interest rate is has been changed based on the post-pandemic and during the post-pandemic financial crisis. And the key issues here has been highlighted in IFRS number 9 and IAS number 39 financial instrument recognition and measurement R&M. And IFRS 7 financial statement. What are the amendation here in IFRS number 9? All of those amendation has been including the relief which apply to all hedging relationship that are directly affected by the interest rate benchmarking reform. And hedging the relationship is affected if the reform raise uncertainty, so we can raise up the amount of the benchmarking based on the cash flow and the future present value of the cash flow. Interest rate benchmarking reform phase 2 amendation, which require that on the 27th of August 2020, IASB published interest rate benchmarking based on different type of industries. In phase 2, the amendments to IFRS number 9, number 7, number 4, and ISA or IAS number 39. So within the publication of the phase 2 amendation, a complete work has been published in response to the amendation, provided temporary relief, which is address all the financial reporting impacts when interbank offered rate, which is the interbank offered rate IBOR, and the replacement or the placement within the alternative nearly risk free interest rate has been applied. So we will invest in sort of a zero interest rate. Definition of material and amendation of IAS and I1 to 8. The main requirement in October 2018 issue some amendation in those standard presentation financial statement and IAS number 8 and a new definition of information or is material of omitting, misstating or obscuring it could reasonably be expected influence decision on the primary user of general purposes. Property, plant, and equipment. There's some changes as well regarding to the proceed of the sales of items produced while bringing the asset to the location, and instead the entity recognized the proceeds from selling such items, and the cost of producing or service producing those items in the profit and loss statement. Onerous contracts, which is the contracts where we couldn't able to fulfill, so we have to calculate some changes. In May 2020, the IASB issued the amendation to the IAS number 37 provision, the corporates of contingent liabilities and contingent assets. The changes apply the direct and related cost approach, which is something regarding to the directly to the contractual or the contract to provide goods and services, including post-instrument cost and allocation of the cost directly related to the contract activities and services. The sales for the contribution of assets between the investors and its associated joint venture. There are also changes as well in the amendation addresses the conflicts between the IFRS number 10. Considering all the financial statements and IAS 28 investment associated with the joint venture, and the losses resulting from the sales or contribute of assets does not constitute the business. However, the requirements and recognize it only for the extended and related investors. This is for the changes has been made recently till the expectation for January 2023, and the changes in IFRS and number 16, number 17, number 9 as an extension for or changes or amendments for IFRS number 4. And the updated issues here regarding to the auditors' response to the risk of the material misstatement arising from the statements made in applying IFRS number 17, which is the insurance contracts. In this case, we have another issues we need to highlight. In this case, regarding to the auditor need to do something regarding to the new cash flow problems, liquidity, and how can we enhance the power for proactivity expectation for the future time. So we need to highlight some skills, competencies regarding to the auditor's response to the risk of material misstatement arising from this type of estimation and applying for the contract or insurance. So this part we will take it after a break for the last pray, and we will be back again soon after finalizing all of those issues. Thank you so much indeed for your time and your attendance for this workshops. Thank you so much. We will continue adding all of those information regarding to the new skills and what we should do, what are the main responsibility for auditing, main responsibility to the changes of post-COVID-19 and revised IFRS in different financial contracts. Thank you and see you after the break. Welcome back again to the second half of this workshop. Thank you for being with us, and we'll start with the auditing responsibility and the changes of IFRS 17. There are some auditing requirements need to be identified, which is number one, they identify and assess or revisit the risk assessment scenario of material misstatement and subsequently the business plan and their auditing response. Identify the risk and including the degree to which the plan are going to assess and rely on the internal control as a part of their testing strategy. While there are many estimating and associated judgment and skepticism in the IFRS number 17, and the auditors must focus on the following in this presentation: the future cash flow, liquidity, discount rate, and risk adjustment, and also the contractual services margin. It's very important to highlight all of those services margin in order to decide what is the future or adjusted future discount rate, and also the cash flow and the liquidity for the future time. To respond to the risk of material misstatement, the auditor must design and perform tests to obtain the significant appropriate audit evidence, and also highlight the changes of risk evaluation and assessment of material statement, and focus on pervasive the evidence need to be adjusted, which is persuasive evidence, which need to be collected through testing how management made the accounting estimation of financial statement, and also develop the estimating point or range that the auditor must estimate in order to highlight the professional and skepticism skills for that. So applying the audit risk-based approach will highlight all of those testing and changes in the future estimation. Also, there are some specialized skills should be added to the auditing comprehensive components and skills for auditing IFRS number 17, and also to highlight the knowledge and receiving resources in auditing IFRS number 17. Auditors may assess the presence of management pays in estimating and providing some example of how auditor may exercise their professional and forensic skepticism. The complete, comprehensive, and competencies of auditing skills should highlight the use of sustainability standards and sustainability rules in environmental world. The issue regarding to the sustainability reports, which should cover the social, economic, and environmental peril and aspects standard, and the framework are already in today's professional accounting toolkits. And also to understand and report information that is transparent, relevant, and magnificent, meaningful to the final user for financial statement. The standard and the auditor should understand and apply appropriate guidance to transaction and reporting, financial sustainability reporting for the auditing job, and determine the use of appropriate measurement and materiality issues in financial statement, and avoid using the misstatement issues. Also, the skills related to the evaluate and impact of the guidance to transaction, trend strategies, business, people, process, and to understand the development and execute process to extract sciences and interpret the complete accurate data and information collected by the auditors. Also, pursuing the knowledge and information and development new objectives matters, which is could help to move from one industry to another, That means we need to know exactly to what extent the auditor could able to multidisciplinary highlighted range of knowledge about different type of industry, companies, organization, and industries as well. So more knowledge they can gain, so the experiential reporting issues could be enhanced through all of those multidisciplinary expertise. So based on the knowledge comprehensive component skills will highlight the accountant and auditors tool kits, and plus the knowledge which highlighted from multidisciplinary industry of knowing transaction, events, requirements, components, and that will persuade the knowledge and the opportunity for accountant to do different things. Confidentiality, and this is include the provision of sustainability related reporting services and products. That will help to the skills and knowledge should be highlighted within the base of business ethics, integrity, and trusted business. This is the professional auditors leading report and assurance on sustainability reporting issues related to the auditing work and job. In case of the building block approach, first of all, we have to highlight how important the stakeholders, but in the first place, we have to highlight the investors focused sustainability information material to enterprise value. This is one block, and this financial material disclosure topics and performance material addressing the sustainability impacts on the enterprise performance and the value chain. The IFRS sustainability standards and guidance should be added to the this type of financial materiality in order to take into consideration all the aspects, and that will need a multidisciplinary professional skills from the auditors. Predictability or reportability should be highlight a multidisciplinary stakeholders focus, not only based on the financial issues, but also disclosure for indicators and contextual information addressing sustainable development impact on public policy and objectives. This public policy and objectives with the multidisciplinary disclosure and the indicators should highlight the global standards of sustainability and the guidance, and also jurisdiction-specific requirements for sustainability reporting issues. This is the multi-stakeholder focused, which is something regarding to sustainability reporting. Along with the enterprise value sustainability reporting issues, we will have a block building a very huge block approach for the customer and the future returns. Encouraging sustainability related to the skills and competency, we have to understand the most efficient way in trusted to integrate necessary reporting requirements, and that does need a multi-culture and multidisciplinary experience from different type of industries in order to highlight and understand the standard and the framework being applied. We need more multidisciplinary communication issues in order to have relevant knowledge about the organization and industry. Also, collaborate internally and externally with the different stakeholders could highlight a lot of the issues regarding to the business and organizational industries. Consider both internal and external assurance of the information to be reported, and that does need more flexible, more multidisciplinary approach in order to highlight all of those financial and sustainability reporting issues and blocks. In order to that, we have to keep a strategic eye guarding the objectives in focus, and then take stock regularity and building a clear targeted reports in order to go agile. All of those steps are very important in order to highlight the going agile for reducing the cost and enhancing dynamics, fast, quicker response, and adaptability for the change, and adaptability for risk and challenges in multiple and short-term approach. That is the agility, and a difference between the auditing agility for catching multi-skills in the future time and non-agile auditing is the word of flexibility, fasting in the responding to the change, adaptability to the change of the digital and non-digital requirement and changes, and the revised IFRS standards, and also take into consideration the probability or adaptability, proactivity to the future change. More agile, more better in terms of devoted and material issues, more higher quality auditors in terms of adapting to the change, easier to adapt to the change, more important, and at least during the initial stages. And the principle may involve more short meeting with the auditees, and that will help easily respond and reduce the time, effort, and cost of the auditing process. So in terms of the non-auditing, in the opposite side, we have to highlight that there is a slow and high cost, more effort spending in order to have the better or the same type of qualities with less performance concentration. Need to formal auditing program revision, more dynamic, and as all teams member participate, more or less quality in terms of the interference with the auditees' time. So in particular, fewer but longer meeting, assuming all goes well. So it does need more effort, more cost, more time, and less flexibility, less quality of services delivered and conducted, auditing services delivered. Combining between the lean and agile in terms of active competencies of auditing work in the future time, especially in post-COVID-19, we can say that there is a new approach called Legile, combining lean and agility approach for the future time. Agility is not about the process, techniques, cost. It's a new approach. It's a new thing which is regarding to the achieving the goal in terms of uncertainty and lacking of information regarding to the post-COVID-19 or virtual challenges and digitization transformation in the future time. So working in the agility, we have individual and interaction over processing and tools, working with the software over a comprehensive auditing process and collecting documentation. Customer collaboration are over contracts negotiation, responding to the change more quicker, more flexible, and more adaptable. Take into consideration all the changes in the future time. This is the audit or agile audit methodology approach. So moving from traditional approach to agile auditing approach, from the perfect communication to frequent communication during the process, rigidly planned activities to quicker iterative activities, from comprehensive documentation with open focused on a different type of documentation. But here we can say that we have a focus on the time relevant and more issues in the reporting and standardization in the reporting issues. Establish the role in hierarchical system, but here we have to empower. In agility, we have empowered role in a more flexible system. Following a person plan or present plan, reporting or responding to the updated needs and the challenges of the future auditing environment, auditing to internal audit response, rescuing to audit and profits. Control of the audit process in the normal or traditional way, but here more transparency in the audit process. That will highlight the new challenges which create new skills we need to understand and fully digest in the future time. Take into consideration agility approach as the new skills and dimensions for the future. So it's not a technique, it's not about cost, it's not about the time, it's about a new approach for take into consideration new issues regarding to the adaptability, flexibility, fasting, and quicker to the change. But the lean is mainly about reducing the cost. It doesn't talk about the doesn't highlight the quality, but it will focus on reducing all type of waste and then reducing the time, the cost, and then the quality will be higher in the future time. But it's not the focus of improving process by focusing on the customer value. And the agility achieve the faster, flexible, better software development and developing the high quality services. Early continuous development and delivery, welcome frequent and late change, strong collaboration between the business and development team, face-to-face conversation, and suitable development and simplicity of the art of maximizing the amount of work which should be done in the future time. The lean is about reducing the cost, reducing the waste, building quality, making a better communication most of the time, but combining the two approach, all we need in order to achieve the agility relationship with the engagement of the customer and be more proactive to the change, to the risk, and then proactive to the solution in the future time. So this is all about the changes in IFRS and the changes in the skills and requirements for auditing process. And we said that the new approach for the auditing skills and auditing procedures is to adapt the agility and going agile to the future time, take into consideration flexibility, adaptability, and time-consuming issues. The changes in post-COVID-19 will be highlighted in this type of changes. We talk about the IFRS number 16, number 9, number 17 is related to the insurance contracts and leasing contracts, and the changes of IFRS number 4 and number 9. Okay, any question regarding to this presentation? If you have something to share, to highlight, to drag our attention regarding to that, we'll be more than happy to take into consideration in this time being or in the second time, next time. Okay.
All clear, and thank you very much for everything.
Okay. Thank you, Mr. Alfred, for that. Thank you so much indeed, and see you for the third or the third lecture for the second week tomorrow, inshallah, at the same time. Thank you so much indeed. I will see you.
Thank you very much.
Thank you.
Izan?
Thank you so much indeed for Mr. Alfred. Thank you.